Good day, 12 a.m. So today is our Fundamentals of Accountancy, Business, and Management 2. For FOBM 2, we will focus on financial statements, which will include Statement of Financial Position or SFP, which we also call the balance sheet. We have Statement of Comprehensive Income or the income statement. We have statement of cash flow and statement of changes in equity. The fifth financial statement is the notes to the financial statements. This course is a second part of Fundamentals of Accountancy and Business Management under the K-12 Basic Curriculum for Senior High School. Okay, so 5M2 focuses on providing lessons in preparation and analysis of financial statements. This will guide you, students, in acquiring knowledge and skills in the analysis of financial statements. Okay, so in this lesson or in this course, it will help us. It will help learners identify the different documents needed for the operation of a business. At the end of each lesson, exercises will be provided for the learners to enhance their analytical skills and knowledge. Okay, so this will also help you in designing internal documents that they can use in the business and identify what external documents will affect your cash transactions. Okay, so you are expected that you will understand and properly prepare the different types and uses of the major financial statements, classify and organize different account titles as applied in the financial statements, analyze and interpret the major financial statements, identify the different needed documents for operation of a business, and orient you regarding the existing taxation law, the train law. Since financial statements will be the sole focus of our FABM2, so for today, we will start it with our statement of financial position. After this lesson, you are expected to describe what is a statement of financial position, identify and differentiate the elements of the SFP, and describe each of them. To prepare SFP using the report form and account form with proper classification of items and current and non-current assets. Okay. So, do you still remember the accounting equation? Okay, so do you still remember the accounting equation? So that is assets is equal to liabilities plus owner's equity. Okay, so again, the accounting equation is assets is equal to liabilities plus owner's equity. Statement of financial position is also known as balance sheet. It provides financial information about the firm's assets. Okay, so when we say assets, those are the resources. Liabilities. Okay, so those are the debts and obligations. Then we have equity. Okay, so, or owner's equity or capital. They are the residual claims of the owners at the end of the accounting period. Okay, so normally it's 1 year. So those are the important parts of statement of financial position. SFP is statement of financial position is very important to the users of the report in terms of the accounting information that it contains for their decision making. Because in statement of financial position, you will be able to see the total resources that your company have. Okay, your total assets, the current assets and non-current assets. How much debts you have in your company and how much is your owner's equity. So it is an aid or a tool that helps users to assess the financial condition of the company. When analyzed over several accounting periods, balance sheet may assist in underlying trends in the financial position of the company. SFP is helpful also in determining the state of the company's liquidity risk, financial risk, credit risk, and business risk. Okay, so we will all tackle on that when we discuss about already financial analysis. When used in conjunction with other financial statements of the company and its competitors, SFP may help to identify relationships and trends which are indicative of potential problems, threats, or areas of further improvement. And lastly, the analysis of the SFP could therefore assist the users to predict the amount, timing, and volatility of the company's future earnings. So the statement of financial position is a major financial statement of a company. So what are the elements of financial position, or what we call SFP or balance sheet? First is asset. Assets could be tangible or intangible. Okay, so they are economic resources owned and controlled by the company or the enterprise that bring in future economic benefits such as income or revenue. Okay, so we have tangible. When you say tangible, it can be hold. Okay, you can touch it. Intangible, you cannot touch it. Tangible, they have physical existence. Tangible assets are deprecated, easier to liquidate due to their physical presence. Costs can be easily determined. Okay, so examples are vehicles, plants, and machinery. Then we have intangible. They do not have physical existence. Okay, intangible assets are amortized, not that easy to liquidate and sell in the market. So cost is much harder to determine. Examples of there are the software, the logo, the copyright, the patent. Okay, so again, assets are used to settle obligations. Okay, because you have their cash, you have their the different properties, so you can use that to settle obligations, to produce goods and services for sale, barter or exchange with another form of asset, and pay off capital investment in the form of drawings. Okay, so assets are classified as current assets and non-current assets. So let's talk about current assets. So in current assets, okay, so there are assets who are easily to be liquidated within a year. Okay, so they are short-term assets. We have cash, cash equivalents, marketable securities, receivables, inventories, prepaid expenses, and accrued income. Okay, so we have cash. Cash includes coins and bills or negotiable instruments such as bank checks or a postal money order used as a medium of exchange. So in cash, we have cash on hand, cash in bank, petty cash fund. When we say cash on hand, for cash items kept within the premise of the company or under the custody of the officer in charge, of the owner or the officer in charge. When we say cash in bank, these are cash deposited in the bank under a current reserve or savings account, and it's not restricted for withdrawal or use. Okay, so it's not restricted for withdrawal or use. Then we have petty cash fund. Petty cash fund are cash intended for small disbursements and kept by the petty cash custodian or officer designated by the management. Then we have cash equivalents. Cash equivalents are short-term, highly liquid investments that are readily convertible to cash. So these are investments with maturity date of 3 months or less, like a 90-day treasury bill or commercial paper. So Again, for cash equivalents, the maturity date should be 3 months or less. Okay, so 90 days or lesser. Consider it as a current asset. So investments with maturity date of 3 months or 90 days. Marketable securities, to be considered marketable, a security must have a face value or near face value transaction within the 1-year period. Okay, so always remember, for current assets should be liquidated within a year. So there must be no restriction on liquidating or selling the product within less than a year. Okay, so example for this is a 20-year treasury bond that will mature in 3 months or less to its maturity date. Then we have receivables. Receivables are collectibles from customers, employees, or officers for the goods or services or money lent by the company from its normal course of business. So we have accounts receivable, notes receivable, other receivables. Accounts receivables, these are receivables or the from borrowers, okay, from borrowers who can use their accounts receivables as collateral to raise. Okay. The next current asset or the next current assets are the receivables. Receivables are collectibles from customers, employees, or officers for the goods or services or money lent by the company from its normal course of business. So we have accounts receivable, notes receivable, and other receivables. Accounts receivables are receivables from customers when goods are sold on credit. Okay, so these are the amount of money owed by customers for purchases made on credit. It can be used as a means of a short-term funding that a business can draw on, and it is called accounts receivable financing with three major types. So we have accounts receivable loans, factoring, and asset-backed securities. Then we have notes receivable. Notes receivables, these are receivables from customers on sale of goods supported by promissory notes. So for notes receivables, the key point there is the promissory note. So it's a written promise to receive money at a future date. Then we have other receivables, receivable, for example, interest receivable. Okay, so we have dividend receivable. So other receivables are residual trade or non-trade receivables that have not been specified by the company. Then the contra asset for receivables. Okay, so when we say contra assets, this is credited. So this is a deduction from receivables. So we have what we call allowance for bad debts or uncollectible accounts. Okay, so this contra asset account, which shows that the estimated uncollectible amount of accounts received to be deducted. Okay, so let's say, for example, you have projected a 2% amount of all your receivables that you cannot collect anymore, then you can allocate that for allowance for bad debts or uncollectible accounts. Then we have inventories. Inventories are assets of the company held for sale in the ordinary course of business. In the process of production for the purpose of selling, or it may take in the form of materials or supplies to be consumed in the production process of the rendition of services. prepaid expenses. Prepaid expenses represent advance payments made such as prepaid rent, prepaid insurance, prepaid advertising, prepaid taxes, and office supplies, which are normally regarded as inventories and expense out when used. Okay, so they are future expenses that are paid in advance. Okay, so these are the examples. Then accrued income. Accrued income or revenue earned but not yet collected. Okay, so revenue earned but not yet collected. Accrued revenue is revenue that has been earned by providing a good service, a good or service, but for which no cash has been received. So accrued revenues are recorded as receivables on the balance sheet to reflect the amount of money that customers owe the business for the goods or services they purchase. Accrued revenue is revenue that has been earned by providing goods or services, but the payment has yet to be received, okay? Has yet to be collected. In other words, cash collection will occur in a subsequent period after the goods or services have been provided. So those are our current assets. For non-current assets, these are tangible and intangible assets with a lifespan of more than 1 year and usually longer, which typically not very liquid. Okay, so any asset that is more than a year, okay, liquidated for more than a year, then they are called non-current assets. So we have examples here, the property, plant, and equipment. So, these are tangible assets with life of more than 1 year and are amortized or depreciated over their useful life. They are used to support the operations of the company. They are actually not intended for liquidation, but they are intended to support the life of the company. So we have there the buildings, machineries, land, furniture, fixtures, vehicles. Okay, and the contra asset for property, plant, and equipment is called accumulated depreciation. Accumulated depreciation represents the decrease in value of a fixed asset due to continued use, wear and tear, passage of time, and obsolescence. So it is a deduction to the cost of the related fixed assets. Then another non-current asset is the long-term investments. Long-term investments are investment for long-term purposes such as investment in stocks, bonds, properties, and funds set up for long-term purposes. Then we have intangible assets. They are non-monetary assets that lack physical substance that gives the owner rights, privileges, and competitive advantages. So examples here, we have the copyright, goodwill, patents, franchise, trade names, trademarks, logo. Okay, so those are intangible assets. Another element of financial position or statement of financial position is what we call the liability. Liabilities are the debts or obligations of the business. They are the present debts or obligations resulting from past events and whose settlement will cause an outflow from the resources of the enterprise. We also have what we call current liabilities and non-current liabilities. Like asset, current liabilities are short-term, should be 1 year and below, and non-current liabilities are to be paid of more than a year. Okay, not only 1 year, but more than a year. So they are called non-current liabilities. For current liabilities, we have accounts payable, notes payable, loans payable, current portion of long-term debt, utilities payable, accrued expenses, unearned deferred income. Current liabilities are expected to be settled within the normal operating cycle of a business, which is 1 year or less. Okay, so accounts payable are liabilities to trade creditors for the acquisition of goods, services, materials, or supplies on credit supported by the oral or implied promise to the company. Then we have notes payable. Okay, so notes payable. This is a liability supported by promissory note issued by the business to the creditor. It may be an interest-bearing or non-interest-bearing note. If you issued the promissory note, then that is a notes payable. But if you receive the promissory note, then that is a notes receivable. Okay, take note of that. If you're the one who issued the note, then you are liable to pay. So that is a notes payable. Loans payable. Okay, loans payable. This is a liability to pay a bank or a financing institution for the money borrowed by the company. The liability is expected to be settled. Then we have the current portion of a long-term debt. Okay, so it arises if portion of the long-term debt becomes payable within a year from the reporting period. This normally arises, okay, so this normally arises from serial bonds or long-term notes that has an amortization of yearly, semi-annually, quarterly, or monthly payments. Then we have utilities payable. This is a liability to pay the services of utility companies. Okay, so like we have PLDT for telephone and internet. We have Luweco for electricity. We have Prime Water for water and other more. Then we have accrued expenses. Accrued expenses are expenses already incurred. You have already used it, but not yet paid. Like accrued salaries, accrued wages, accrued taxes, and accrued interest. Then we have unearned income or deferred income. So these are payments received in advance from customers. So payments received in advance from customers. Since you have already received the payment, but you have not yet delivered the goods or provided the service, then that is a liability because you are yet to render, okay, or deliver the product or the service in the near future. Okay, so examples here are rent income, gift certificates, interest collected. Okay, so interest collected in advance and payment of customers on undelivered goods. Then another one for current liability are the payables to government agencies. Okay, so these are the collections made from employees as a deduction from their salary, which are subject to remittance to government securities like SSS, the SSS premiums payable, GSIS premiums payable, HDMF, or the Pag-ibig Fund, okay, with the PhilHealth premiums and the withholding tax payable. So again, those are our current liabilities. Then we have non-current liability. Okay, so non-current liabilities are long-term debts or obligations which are not expected to be paid within a year or the normal operating cycle. So we have three types of non-current liabilities. We have liabilities arising from raising funds for particular purpose. Examples are the issuance of bonds, long-term lease obligations, and long-term notes payable. Then we have liabilities as brought by the ordinary operations of the company. Examples are pension funds of employees and the deferred income tax liabilities. Then we have liabilities that depends on the occurrence or non-occurrence of one or more future events. Examples are warranties, restructuring, environmental liabilities. Okay, so those are our non-current liabilities. Okay, so examples for non-current liabilities, I'll just give you some examples. We have long-term notes payable. These are issued by the company to suppliers or financial institution concerned and evidenced by a promissory note and expected to be settled beyond a year. Then we also have what we call, what's that again? The real estate mortgage payable, an obligation secured by the real property of the company. Okay, so there's a real estate mortgage, and of course, that is payable beyond a year. We have chattel mortgage, obligation where the liability is secured by movable assets such as vehicle, machine, or equipment. Then, of course, we have bonds payable, okay, a form of long-term debt usually issued by corporations, hospitals, and governments. So the issuer of bonds makes a formal promise or agreement to pay interest usually every 6 months and to pay the principal or maturity amount at a specified date of some years in the future. Okay, so it's more than a year. The agreement containing the details of the bonds payable is known as the bond indenture. Okay, so the settlement of these debts or obligations is through the form of cash, rendering services, another debt obligation, replacement by another debt obligation, and conversion of debt into capital. And of course, the creditor may waive his right also to collect the existing obligation. The third element of a statement of financial position is the capital or owner's equity. Okay, so capital is the value of cash and other assets invested in the business by the owners of the business. Together with the capital, we also what we call, okay, so capital is also the ownership claim on total assets, residual equity, investment by owners plus revenues, and drawings and expenses. Drawings and expenses, this is an account, a contra capital account debited for assets withdrawn by the owner for personal use from the business. Then we have two formats of statement of financial position. There are two forms. We have what we call account form or the horizontal format, and we have the report form or the vertical format. Okay, so always remember the rules in the financial statements. Of course, we have the heading, which includes the name of the company, the title of the financial statement, and the date. So we use as of December 31, 2019. So in balance sheet or statement of financial position, we state the date as of. Okay, usually it is for a year. For captions, it designates the major elements. Okay, major elements, we have assets, liabilities, and owner's equity. Okay, so there are indentions. For assets, we have current assets, non-current assets, and we have indentions in every classifications. And we call a balance sheet with a classified accounts as classified balance sheet. Okay, so there's indention, and of course there is a money column. Okay, so there's a money column and the currency signs. Don't forget the currency sign. So there should also be a peso sign here. A single line rule, okay, is drawn under the last amount to be added, but a double rule for the final amount. Okay, so that is the parts of financial position statement. The accounts for the arrangement of accounts, take note of this. The accounts are arranged accordingly to liquidity of the assets. Like, for example, you start for current assets and you list the most liquid, then non-current assets will be next. Okay, so they are arranged from the lowest amount to the highest amount, except for the land that generated usually or listed first, always. So land is always listed first. For liabilities, they are arranged based on time of maturity, where the currently due are listed first. So the first liability to be settled will be listed first. And then, of course, we have owner's equity, the capital, before drawing, and net income. So this is an account form, It's a horizontal form. Then the vertical form is the report form. Take note, International Accounting Standards or IAS, IS1 does not prescribe the order or format in which items are to be presented in the SFP. It simply states that it should be according to the nature of the company and its transactions, and the information is necessary for an overall understanding of the company's financial position. Illustration 1, let's say for example for this illustration 1, the trial balance of Dimples Enterprises was prepared for the period covering January 1 to June 30, 2019. As an accountant, you are required to prepare a statement of financial position as of June 30, 2016 in an account form. Okay, so Dimples Enterprises, you list all the, this is the trial balance. Okay, so we have here the cash, accounts receivable, then supplies, prepaid rent, delivery truck, office equipment, furnitures, accumulated depreciation, accounts payable, tax payable, long-term notes payable, mortgage payable, Dimples capital, Dimples drawing, net income, and of course the total. Now let's see the solution. Okay, so this is now the account form of Dimples Enterprises. The statement of financial position as of June 30, 2019, or just simply June 30, 2019. So we have listed here the assets. We have current assets indented with the different current assets, then total current assets there. Then we have non-current assets. We have here the different non-current assets, then total number of total non-current assets, then total assets. At the other side, we have liabilities and owner's equity. Current liabilities we have here listed, indented also. Then non-current liabilities with indentation. We have the total liabilities total here because we have to add the owner's equity. Then here's the owner's equity, the total owner's equity. And lastly, total liabilities and owner's equity. Okay, so they should be balanced. Okay, they should be balanced. Take note, you can present your SFP as like it or like that or the previous one. Let me see. Okay, so like this. Okay, so any of which. Then another illustration. Okay, so below is the summary of transactions of Mystic Merchandising as of December 31, 2019. Prepare a statement of financial position in report form. So we are going to present a report form, okay, for this trial balance. So let's see. So this is now the report form. We have assets there, non-current, current assets and non-current assets. Look at how it is being presented. Okay, so because see there is allowance for bad debts there, so this is now the total accounts receivable. So it is deducted. So if you place here less, don't put negative anymore with this amount. Okay, and current assets, then we have liabilities and owner's equity. So that is the report form. So in summary, the statement of financial position or balance sheet reports the resources available for the company to use, obligations that the company is required to settle, and the equity that belongs to the owners of the company. SFP is a snapshot of the financial position of the company. And as in an SFP, we have the accounting equation, assets is equal to liabilities plus owner's equity. Okay, so that's all for our statement of financial position. For any questions or clarifications, you may send me a message through the Google Classroom or through our messenger or our group chat. Okay, so with this class, I'll be posting this video in your Google Classroom and please check for your activity. Have a great day and please stay safe always.